I'm here to help you make money in the stock market. And I believe that content like this is extremely valuable, especially if you're newer to the market, if you're a newer investor. But even if you're not new to investing, this content is still going to help you because I believe this so much. I'm passionate about trying to help you and I really enjoy what I do. I want to share this chart day again from the private community. I did it a couple weeks. Here's another episode for you, raw and uncut. It's Wednesday, February 4th. I'm your host, Eric, Mr. Fired Up Wealth, and it's time for another installment of Chart Day. We do these every single Wednesday in our private community, Patreon, Discord, and we have now since 2020. So we're going on like 6 years this year. It'll be 6-year anniversary. Hope you guys are doing great. What we're going to do today is we're going to look at the S&P 500, the QQQ, and I think 17 individual stock tickers. We always have a few that don't qualify. Usually it's 20, but I think we have 17 today. Before we do that, I'm going to head over and look at some news because there's a lot going on. I have a lot of pent up energy and I need to get some of this out. So the first thing I'm going to do is I'm going to head over and I'm going to look at the futures. Now, software is selling off. You're having a rotation. If you remember in December of 2025, I told you that 2026 would be choppy. It would have some volatility, especially in earnings season, have some cash. The market's going to be more selective. And the market's going to be more selective for companies that have high multiples, that aren't profitable. But what's interesting about that is we have double standards right now. And what I mean by that is anything that's space related, whether it's Rocket Lab, let's just look at that stock really quick. This is one. We've made a lot of money on this stock, thanks to Derek and team in the space exploration channel and Discord. And yeah, it's pulled back a little bit. Thing was a little bit higher. It got up to whatever the hell this is up here, $96, and now it's 81. But it was just under $5 here in June, a penny stock. And people are willing to pay extreme premiums, $43 billion market cap, because why not? SpaceX is going to come public in IPO at $1.5 trillion. If I can own the next best thing, let's just keep pumping it up. Doesn't matter valuation. And it's not just Rocket Lab, because that's actually one of that's probably the best company that you can invest in the space sector, most would agree. But whether it's ASTS or it's this stock or that stock, anything with the name space in it, people are just buying it hand over fist. Sometimes software is cool. It's called fashionable. Sometimes it's this, sometimes it's that. The narrative just a couple weeks ago, the narrative was that AI is not really a thing, not really too worried about it. Let's sell our AI stocks. I think this is kind of a fad. We're getting kind of peaked out here. It went from that to, hey, wait a minute. We're actually seeing proof that AI is doing some good things. And instead of AI as a joke, it's actually eating the world. And it's going to replace all software companies. AI agents, I was told the other day that because of AI agents are getting so smart. This is an actual comment on social media that they can build their own data centers and now they don't need NVIDIA GPUs. And this is the kind of stuff. And most people are smart enough to hear that and say, well, that's not true. The problem is there's a lot of other stuff that's said that's just as funny to someone like me that isn't true, but you might not know the difference. And one of those examples is you turn on CNBC, make the mistake of turning that on for 2 minutes, and you got a guy like, Palantir is the only software company that can really survive if you think about what's happening with AI. Really? That's really what you believe? So at 60 EV/NTM revenue, you're telling your clients to buy that stock. We were buying the stock at $9 and $10, but let's go buy. Hey, it was almost 200. It pulled back to 150. It's a great buy. Maybe it is. But to go on national TV and tell the world that that's the only software stock that's going to do well and survive, it's so short-sighted. And these people don't have any experience working in software. They literally are just pulling stuff out of the air. And there was another comment on Bloomberg Technology about, NVIDIA, has to worry about this and that. Talking about NVIDIA, like the downfall of NVIDIA. You look at the person's background, and I'm not bashing anybody that has a music background or anything like that, but she's got like advanced degrees in music and pivots to finance in 2016. It takes you 5 years to even get out of the rookie phase when you're investing. And so at 10 years, you're kind of like a sophomore. And so you're going to go on there and tell me about NVIDIA, even though you didn't buy it and ride the wave up, you're going to tell me about how bad it is now at what you think is the top. And I tell you this stuff because you have to be aware. Everybody's got an agenda. A lot of people don't really know what they're talking about. They're just feeding you some sort of agenda because it's helping them in some way, whether they have puts or they're short or who, God knows what the reasoning is. Maybe just to try to sound smart sometimes when you don't really know what you're talking about. So, we got futures and you got oil, 63, you got gold here, 5,084, Bitcoin under 75,000. We had payroll this morning. Payrolls rose by 22,000 short of expectations. So you can see the consensus forecast, 45,000, got 22,000. Weak job market equals lower rates usually, which in theory should help high flyer names. So software is out of fashion now. It's not cool because software is going to get completely replaced by AI. The reality is that AI needs to bolt on some sort of backbone to work. And I've been telling you this for weeks. Jensen Huang actually just was at Cisco at the AI conference hosted by Cisco in San Francisco. And he pushed back and basically said, it's the most illogical thing in the world. The market is wrong about software stocks. So this was actually posted in Discord, and I appreciate you sharing this. So the notion that AI is somehow going to replace software companies is the most illogical thing in the world, and time will prove itself. This happened February 3rd, yesterday. Now, I agree with that. Some companies, yes. Other companies, no. On Monday, I did a live stream, and I told you which companies I think are going to do well. I told you which companies to avoid. It doesn't mean the ones that you should avoid can't do well. It means they have the higher risk for disruption. It also doesn't mean that you should go out and buy a bunch of software stocks because I tell you all the time, if it's SaaS, you shouldn't own it. And if you do, it should be spec. Now, I've told you that hundreds of times. A lot of people don't follow it. Now, hopefully you understand why. Let me just show you a couple of charts. But first, before I do that, so Jensen Huang's a smart guy. The market's gotten AI wrong from the get-go, from the jump in the end of 2022 till now. They were way behind the curve on NVIDIA, on Broadcom, on AMD, on all of them. And the market is always very reactive. It doesn't always, it tries to be forward-looking, but it does a bad job and usually fails at it. So the market's trying to be forward-looking like, hey, software is going to zero. We should sell out of it now. And then they'll go buy stuff like, oh, hey, Caterpillar. Let's go buy Caterpillar where, let's look at Caterpillar. I'm not bashing Caterpillar. It's a good company. But the logic here, like, let's rotate out of, we'll still hold on to some of those data center stocks, but there's no phase two needed anymore. So we talk about phase one infrastructure with the Palantirs and the MongoDBs and Snowflakes. Then we talk about, the phase one infrastructure with the NVIDIAs, the AMDs, the Broadcoms. The phase two is going to be the Palantirs, the MongoDBs, the Snowflakes. That's going to be the ontology, the data connection part. Being able to use your enterprise data, right, with these LLMs, make it meaningful, cleaning the data, organizing the data, making your company proprietary data useful. You can talk to your data as an organization. You can't do that with just hardware. Hardware is going to build that infrastructure so you have those AI factories, those data centers. That's something that, we called from the get-go. The market missed that. And then more CapEx spend. There's plenty of opportunities in phase one still. People are still bullish on phase one, but they're completely misunderstanding phase two. AI can't float around in the universe by itself and have nothing to latch onto. It needs an ecosystem, needs a platform. There's their first 1 day free timeout for a day. Congratulations. Okay, so Caterpillar. And I've been literally yelling. I was with my broker friend last night talking at a bar for 3 hours, yelling. So my voice is shot. Hey, let's pay 31 for gap PE ratio for Caterpillar. That's growing at 6.9%. And yeah, it pays a dividend, but it's 0.86% because the price has gone up so much. And a lot of fringe players like that. And there's not logic a lot of times with the market. Like let's sell a CrowdStrike cybersecurity, which is mission critical stuff. AI is not replacing that, by the way. Let's sell that and buy Caterpillar. And you say, well, the valuations are high. Well, yeah, that's true. And it makes sense that we revalue them and give them lower valuations. But here's the thing. I want to show you a couple things. I'm going to show you some charts, and I'm also going to show you a narrative. Okay, so the first thing I want to show you, I'm just going to copy paste this up in Google. Jensen Huang, market's wrong about software stocks. All right, what we talked about earlier. I'm going to hit enter. Now, if the market wanted you to see this and the narrative was to push software stocks higher, what do you think would happen if I clicked enter on that? Now, this is under all. There should be 20 different CNBC, there should be articles about this from Wall Street Journal and Forbes. Guess what? There aren't any. You know why? Because it doesn't fit the narrative right now. Are we going to write Jensen Huang off and say he doesn't know what he's talking about when he's basically the godfather of AI? We're going to ignore it and just keep selling stocks the next day? Sure. You know why? Because most people didn't see this information because CNBC is not going to spoon feed you it. It doesn't fit the narrative right now. The narrative is to sell software to zero. And I can almost guarantee you that those same people that are telling you to sell, they're going to be buying when they think it's the bottom. Because they have to be smarter than that. Now, on top of that, let me go to the charts. Stay with the flow. I want to show you a couple charts. The first one I'll show you is ServiceNow. This was $239. Look at this selling, you guys. This is something that you would see. In 2022, the selling wasn't even this bad. You would have had levels where it's like, oh, it's going down, I want to buy some. And it would look like this. It would look like this and take time. This is just a flush, dump it all. And every single chart pretty much looks like that, except maybe Palantir and a couple others. Now you've got S3 down here in ServiceNow, 87.71. Because as it gets oversold and it gets broken technically, it's just going to keep lowering. And if it keeps going lower, you're going to have new S3s down here. And that's the thing. People don't understand. If you say, hey, I like the stock at 115 and it keeps selling to 100, now you've got different supports that are going to be lower. That's just the way it is. These are possibilities that are going to change. It's not like a guarantee. So people get it twisted, especially casual, traders, whatever you want to call them on YouTube. Oh, well, you said you liked it at this price. Yeah. The whole narrative has changed since that first buy came out on a stock like ServiceNow. Am I still bullish on it? Sure. But is it going to happen sometimes where it goes lower? Maybe you're down 15, 20% on a stock before it reverses? Yeah, all the time, especially if you're a growth investor. The reality is you haven't been around long enough to understand it. And that's okay. It's okay to be new. It takes you 5 years to even get out of the rookie phase. And that's 5 years of like learning and grinding, not just casually like trading on a Robinhood app. Look at another one here. Guidewire. My wife works here. I mean, look at that. We just sold some at like 250 and I was telling her, hey, we should sell some of this. And I don't think it's worth 250. It seems a little stretch. And of course it goes to 270. I think we sold it on the way up to here. He had like a limit order up and it went higher. Well, now the 250 doesn't seem so bad when it's $129. And look at that selling. That's this. I mean, this is a crash. It's a crash in software. And I can show you chart after chart after chart. It looks like that. Now, here's the thing, though. When you say the market's crashing, the market is the S&P 500. The market's not crashing. In fact, the S&P 500, the VU here, is up almost 1% year to date. And you say, well, yeah, it's because you're rotating and, VU is not all tech, so QQQ is getting hammered. No, it's not. It's actually up 0.55% year to date. It's flat. So even with being down pre-market 0.27, it's still green slightly. It's basically flat. Started the year on January 2nd, 613. It's 614 after hours. So what's going on here? Why? Some of you are like, well, I'm down 4% yesterday, 5%. You know why? And if it's okay if you're down and you understand why you're down and it fits your risk tolerance. But with a lot of you guys, it's Hey, I want my cake and eat it too. I want all the alpha on the upside, but I don't want the beta. So even though you tell me not to go too heavy on some of these software names and to treat them like spec, really avoid them, I'm not going to listen. I'm going to make it 25% of my portfolio. And then when I'm down 5%, I'm going to cry about it. That's because you decided to take that risk and you didn't follow the instructions or the blueprint. And that's okay because it's your money and you can do whatever you want. But what I don't want to do see is people in Discord then complaining about it and doing woulda, coulda, shoulda. And yes, it is going to fire me up and bad things are going to happen. So just don't do it. Because I expect a lot better from our community than that. We should not be doing shoulda, coulda, woulda, should have done this. I wish I would have done that. And you could flip and say it's a learning experience. No, it's dwelling on the past. Because a learning experience, you're going to reflect and share the learning experience, not just I shouldn't have done this. I wish I wouldn't have done that. That's not a learning. That's not sharing a learning experience. You're going to have to go deeper than that one sentence. All that is venting to make yourself feel better. And I'll get off that topic. But understand that if you're down big yesterday, that's because you're chasing alpha. And if you're chasing alpha and you're okay with the gains you get from the alpha, you have to be okay with the downside as well. You can't have your cake and eat it too. It doesn't work that way. So adjust your blueprint to your risk tolerance. If it was down too much, that tells you that you need to adjust your risk tolerance, your allocations to your risk tolerance. Now, somebody thought they were cute and went on social media and said, "Oh, Mr. Software is worried." Okay. So now I'm Mr. Software, yet if I look at my net worth, software is less than 10% of my net worth. And it's all house shares, except for the community portfolio. Those are new positions, like the Axons, the ServiceNows, the Rubrics. Everything else, CrowdStrike, owned it since 2019. Cloudflare started buying it in 2019, 2020. I've sold hundreds of thousands of dollars. I just funded $800,000 in a dividend portfolio. You know where that came from? It came from growth, selling growth to convert it into blue chip dividend stocks. The whole point of Fired Up Wealth, financial independence, retire early with dividends. So I got 3 portfolios, one for each risk tolerance. The community portfolio is a 20-year-old version of myself, 20 years ago, 25, trying to get to millionaire status. I'm going to take risks. I'm going to have alpha and I'm going to outperform like 250% in 3 years. But when the market decides something's not fashionable and I own that in the portfolio, there's going to be beta with that as well. And that's okay because I accept the gains and I accept the downside with it. And that's what I have to do as an investor. But it's hilarious how many people online misconstrue and think I have this portfolio, like my net worth is all in software and it's leveraged and I didn't buy it 6 years ago at way, way lower prices. House shares means I've basically sold what I initially invested, usually hundreds, 200, 300% more on a lot of these names. So literally they could all go to zero and I still made bank. So, you can judge online and say this or that and make assumptions, but it's wrong. And that's okay. That's what the internet does. But I want to set the story straight there. Okay, so moving on. Another thing I saw this morning, somebody said on Facebook, well, everybody knows, February is the worst month for the stock market. It's a weak month. Hey, Grok, is that true? No, it's not true. September is the worst month, averages negative 0.6 to negative 0.8. February on average is basically flat. Basically flat since 1950. But yeah, everybody thinks they know everything and they'll tell you stuff and post stuff. Take everything you see on the internet with a grain of salt. And now you've got AI tools. Go fact check it. It's really easy to do. It was easy to do on Google too, but now it's really easy to do. Okay, so I think I got all that out of the way. But the Qs aren't crashing. The market's not crashing. If you're down big, you know why that is? Because you're not diversified and you probably have too much software. But this is why the Fired Up Wealth methodology, the blueprint methodology, I'm teaching to have ETFs, dividend stocks, not to own all one sector. If you do invest in software, it should be a small percentage, but that's just one sector. You got to make sure you have different areas. Things like John Deere. We own John Deere in the growth portfolios. And sometimes people poke fun at it, Oh, John Deere I'm not going to own that. I can't get, I'm not going to get rich on John Deere. No, you're not. But you know what it does? When the market's selling off, stocks like John Deere are going up, and it's going to help hold up that portfolio, which is exactly what you're seeing on something like the S&P 500, even the VU. The VU is still diversified in there and has that mega cap tech. And obviously tech is a big component of these indexes, but it's going to own other stuff that's going to help support it and hold it up. And most of those SaaS companies, like a Rubrik, is not going to be in the S&P 500 and these other indexes as well. But, John Deere is up 16.75% year to date. People kind of made fun of SCHD last year. I started buying that to build up the dividend portfolio. Well, I mean, it's up almost basically 10% year to date, which sucks because I wanted to put in like 300 or 400 grand into this, and I've been buying 1,000 or 2,000 a day, and it keeps going higher and higher. And it's like, I don't want to be on that side of the curve where I'm starting to chase it. But understand, the people that have some balance in their portfolio that aren't just extreme alpha chasers, they're not getting hurt that bad. If you are, that's okay, as long as you own it. Hey, I made the decision to be super aggressive, and I'm going to take the good and the bad with the good. Or you say, hey, I don't have that kind of risk tolerance. I'm going to have some diversification and not own a bunch of stocks that can drop 50%. That's the whole reason I tell you guys to avoid software stocks like SaaS, because they can drop 50% in a heartbeat. And I tell most people to avoid them because they don't have the experience and they can't handle that. They can't stomach that volatility, that beta. So first thing we're going to do is look at S&P 500. If you see yellow, it's today's chart day. Orange is the previous chart day. Apologize for the voice. Just a lot of stuff that has to come out, and it was already kind of bad. I was sick over Christmas and never healed. And for all the people that are going to drop comments, like put some, have some tea and honey and ginger here. Okay, this has ginger, right? This has lemon. This has honey. It has a bunch of different like turmeric and all kinds of stuff in the tea. All right. So you don't have to comment like I'm going to drink tea and it's going to magically fix my voice. It doesn't really do anything, but I'm going to do it and try it anyway. Okay. I'm being facetious. It's my way of entertaining myself. I don't think you guys realize how much time I spend in this studio grinding the market, trying to help myself and you. The whole idea is that I'm doing this anyway. I want to share my data and my passion with you guys. But this is what I do all day, every day. And it gets pretty boring and lonely sometimes if you're just sitting here grinding away, and sometimes you got to entertain yourself. And people also have to give me some slack too. They have to understand my perspective of what I'm dealing with, like a day like yesterday. Uh-oh, red lime. Red lime. Timeout. Oh. And then he left. Now I gotta manually do it. Hold on. There he is. Now I got to do my phone because I can't do it from that. Making it hard on me. Tricky. All right. Red lime. Oh, yes way. Yes way. All right. Timeout. One day. Boom. All right. So it's all good. It's just a day. You can still read everything. It's kind of in good fun. It's a free 1 day timeout. You can read, but you can't post. Okay. If I start doing stuff like that, it'll help people hopefully not do it. We just got to get better at some of that stuff. I know people make mistakes, and that's okay. If I go and I'm doing 80 and a 60 and I get pulled over and get a ticket, hey, I made a mistake. Oh, that's fine. Here's the fine. All right. That's how it goes. SPX. So for anyone panicking, here's the market. Oh my God, the stock market's crashing. I already showed you. It hasn't even moved. It's at the 50-day simple moving average. This 200-day simple moving average is all the way down here, 64.40. And we still have a bullish bias on the S&P 500, but the Qs actually tell a different story, and I'll show that. If the Qs break, this is going to break too. It's pretty hard for one to, S&P is going to keep going green forever. Now, you can have some divergence there, but only to a point. February is known as an accumulation month, so it's not the worst month. It's an accumulation month because generally it's flat, but whenever the market's flat like it is now, it creates opportunities under the hood because people are going to be jockeying in January, February. Now they're taking profits from the stuff that worked in 25 or last year, and they're going to start jockeying for what's going to work by the end of this year, especially institutions. And so that's why you're seeing software, for example, hey, we bought that, we made some profit, we're going to sell it. Now we're going to rotate into energy, financials. We're going to get more balance, not so much AI. We'll keep some of the winners, like some of these NVIDIAs and Broadcoms, but we're going to lower the exposure a little bit. We're going to get rid of some of the riskier type stuff. We're going to rotate into space stocks because everybody's buying them. And you know what? Even though the valuations don't make sense, when the SpaceX IPO comes out, all of them are going to trade higher in a basket. That's kind of the mindset. Be careful with that, though, because you see what happens. So this is accumulation month. This is a good month for long-term investors because we get opportunities to buy. If you've been around the block, you understand that days like yesterday are good things. Doesn't mean that it can't go lower. It doesn't mean it's bottom feeding. Just means that, hey, I can buy Microsoft at a price I think is attractive, and it can go lower, but I'll buy more when it goes lower too, and so on. So at this point, here's where we're at, and we haven't really gone down much at all. Now the QQQ, this is under pressure below 640, and 565 to 595 is very possible. That's this yellow circle. 572 would be a 10% correction from these $636 highs right here. So 636 down to about here, a little lower, 572, something like that. This would be a 10% correction from that top. And that's probably what the market needs. And I told you guys last year, you'd probably see a 10% correction. And that it might not necessarily be in the market, but it could be in tech. It could be in certain sectors. The market was going to be more selective. And you're seeing that play out. The market's being selective. Software is trash. This is good. That's not good. That's okay. I like to buy against the grain. So last year, I was buying dividend stocks when everybody was chasing growth at all-time highs in FOMO. I had already bought those growth stocks when everybody else was buying dividend stocks, like in 2022. Everybody was buying Starbucks and dividend stocks. These are safer. Don't buy the growth stocks. They're going to go out of business. Full fear of losing everything. And he said, hey, that's fine. I'm going to build up my blueprint. I'm going to buy growth stocks. In fact, I'm going to start a new portfolio, the Fired Up Wealth Community Portfolio. And I'm going to start investing from zero. And I'm going to start buying these growth stocks and show you exactly what I would do to invest as a new investor. And that portfolio has crushed it over the last 3 years. So we were buying those stocks and everybody's buying dividend stocks. Last year, I was buying dividend stocks and everybody's buying growth stocks. Now it's tough because it's a blend. You're getting some of those dividend stocks going higher and you're getting some opportunities and pockets of growth like software. And coming from a software background, like I said, I less than 10% of my net worth in software, but I've also made well over $1 million in profits off of software SaaS. And the stuff I do own is really house shares, except for the community portfolio, like I said earlier. And those are pretty small positions based on the net worth. That portfolio is much smaller. See if I'm down 15%, if I look at the grand scheme of things on a $4 million portfolio, it's not really a big deal. And I'm not trying to discredit it, but I also want people to understand that it's like, I haven't lost a bunch of money in software. It's the exact opposite of that. So, this is the QQQ. It's under pressure. It needs to get 640. It's 615 pre-market. I do think you could see it come down in this yellow circle. It doesn't have to happen. It would be healthy. It'd be welcomed. Don't be scared. Do not have full fear of losing everything. Because what happened is you had FOMO this whole time, fear of missing out. And then when stuff does go on sale, and right now it's not, like this chart is nothing. But if I show you a chart like, for example, this. Now here's the other thing. You can't borrow my conviction. If I think that ServiceNow is going to do well, you can't just say, well, Eric believes it, so I believe it too. No, you have to have your own thesis, your own conviction. But this, in my book, this is where stocks are an opportunity. When everybody wants to throw them away, when there's fear of losing everything, these are going zero, AI is replacing everything, you don't need software anymore. I want to buy that fear. With that said, I'm not going and making this 10% of my portfolio or anything stupid like that either. It might be a couple percent for most people if they even touch it. And again, I always say, hey, avoid SaaS. If you're going to buy it, spec usually is 1%. And people on YouTube, if I post this on YouTube, which I might, people on YouTube be like, well, that doesn't make sense. Warren Buffett, he's really concentrated in a handful of stocks. Not really. If you use the entire portfolio of Berkshire Hathaway, the entire blueprint, which includes all the private companies. So what you see is that public portfolio. That's the stocks they own, and Apple is a big component of that. But if you take the entire conglomerate, the entire umbrella, the highest concentration that Berkshire Hathaway has is Apple. The last time I looked, and it's something like 8% of the total assets, which basically falls right in line with what we teach in Fired Up Wealth Blueprint methodology. We like to have 5% kind of max. Sometimes you go a little higher on names like NVIDIA and stuff if they grow into that. I think I have like 13% of the main portfolio in NVIDIA, which is kind of breaking that discipline, but you don't have to be super concentrated. And yeah, if you have a small portfolio, it's not going to move the needle as much. But where people get that wrong is you have to look at percentages. If you're up 50%, that's your goal. If you get 50% returns in a year, I can't help it if it's a $25 portfolio, if it's a $25 million portfolio. Of course, the numbers are going to be different. But you have to focus on the percentages, not the dollars. And when you start focusing on the dollars, that's when you start to try to get rich quick. That's when you start chasing stupid stuff. And that's when you start losing money. If your goal is to get rich quick, you're going to do the opposite, and you're going to actually lose money. So this is very much a marathon and not a sprint. And it's very hard to convince you of that, but you just have to believe, if you're trying to be a long-term investor, that is the only way really to true, sustainable, generational long-term wealth. So now that I've gone off for 30 minutes and bored half of you to death, probably, I don't know if anybody learns from this, or, most of you are probably just here for the charts. Where should I buy a stock? And that's fine. Whatever. I do my best, and that's all I can do. And for some people it helps. And for others, do your thing. It's your money. My magical tea is not working. So Tesla, Derek, close your ears. I mean, the fundamentals don't support the valuation. We talk about qualitative and quantitative analysis. You can't really use quantitative analysis for Tesla. It's very much a qualitative story. So if you're a value investor, this is not your Huckleberry. There's a lot of excitement for the future with robotaxis, Optimus, I said Oculus, Optimus robots. And, quite frankly, it has a cult following. You can call it a cult following. You can call it meme stocks. You can call it whatever. Want to look at something really quick? So Oracle's below 150. I do think Oracle can go lower. I had a good till canceled order in the main portfolio that just went off at 149.97 for 15 shares. Now this is dollar cost averaging up. My cost basis is like 130. It probably is different now because I just added some. But Oracle, if you look at this, I told you guys the sentiment's bad and to be patient. In my book, this is where I start buying, right? I've been buying, nibbling a little bit. This S3 is down here at 131. I think that's very possible. The April lows is 117. So, I mean, you're getting in the range where it's starting to get pretty attractive, in my opinion. And with sentiment, I mean, the thing is, it could go to $100, and I'll love that. If you remember, I bought some of this, and I started buying it, somewhere in here, and it went down to here. And so I have a cost basis somewhere in the middle, whatever, slightly lower than where we're at. And it ripped up here. I said, hey, trim this, don't chase it. Hopefully it comes back, hey, I think 250, you're going to see below 250 later. When it started to sell off, I said, well, that 250 is more like 175. And as the 175 came lower, 150, and I'm telling you now, it can go 125. And then it can, if people keep selling and the chart looks like this, you have to understand it can keep going lower. The answer is it can always go lower. Nobody has a crystal ball to know exactly when it's going to bottom. And there's the other school of thought is you can wait till where you think it bottoms and you can buy that. And some people do that. If you use the Fired Up Wealth technical analysis lot allocation strategy, it works every single time as long as the stock rebounds and you end up getting great cost basis, but you have to train your brain how you're going to do things. And if it doesn't work for you, do whatever you want. Some people are like, hey, I only have $1,000. What should I do? Well, probably buy an index fund. If you're trying to chase the one stock that's going to give you the highest returns, again, you're trying to get rich. You're probably just going to lose money. All right. So that's Oracle. I like it under 150. Always can go lower. S3 is 131. So back to Tesla. I like the company. I own it. I've owned it for a while. I've made money on Tesla. S2 is 407.44. And so that would be here. And then the S3 is 390.74 cents. That previous S3 in the 200-day, which is this level right here, that's $378. What's Tesla worth? Honestly, probably between 250 and 300, but it doesn't matter. If the cult following wants to take it to 500, then they're going to take it to 500. This last earnings was not really a great earnings report, yet the stock held up pretty well. Why? Well, a lot of it comes back to the excitement for future and the cult following. And these can be unpredictable. They won't make sense if you're trying to use quantitative data only. You got to use a blend of quantitative and qualitative. And that's really what it takes to be a successful growth investor. And that's why people like accountants often struggle at growth investing, because they want very like black and white, low PE ratio, or for a value investor. If you're trying to be a growth investor, that's just not how it works. You have to use both. It's a mix. Technicals are the last 1%, 99% fundamentals, which is a mix of qualitative and quantitative analysis. This is much more qualitative than a quantitative story. Will it get to 250, 300? Probably not. It doesn't follow rules. So these are your numbers I just gave you. And you have to decide, do I want to own this in my portfolio? How much percentage? And then determine there how to buy it. And I recently broke down in Patreon. I shared with you a bunch of stuff. I mean, I've just been lighting you guys up with content. Hopefully you guys appreciate that. But this right here, the arts of dollar cost averaging, 7 practical steps to mastering a winning investing framework. If you're ever wondering where this stuff is, go to announcements. Usually I post stuff like, here's the second video in the conference series. I post all these videos and stuff in the announcements and polls here. I also post them usually every time, excuse me, under the Patreon exclusives. So, this is yesterday's stock market sell-off. Listen to this. You can find the Axon updates for Fibonacci's. You can find Monday's podcast, 10 must-buy stocks, 10 to avoid. This tells you the game plan of how to win if you're buying software. Just opened 3 seats, Elite Masterclass. They filled instantly, it's good to see. I get emails and stuff all the time, pretty much daily. Hey, when are you going to open up seats? And it's hard because like, if you saw what happened yesterday, that's why we want to close the community, especially in times like this. It's just, I'm not going to spend a lot of time talking about it, but you have to understand. We've been doing this a long time and we know what works and we've seen what happens. But all this stuff is here, guys. And I kind of went off the other day and I recorded a audio podcast and I ended up deleting it. I probably shouldn't have deleted it, but I was pretty harsh and I didn't want it to come off the wrong way. But the ultimate takeaway from that, if you didn't listen to it, I think only maybe 10, 20 people did, is that if you look at what we've done here, we've essentially built a lake in the middle of an oasis and said, hey, horse, drink the water. And sometimes people just don't drink it. And you're like, there was someone, and I'm not picking on you. No one's going to know probably who I'm even talking about. But this person was like, hey, I asked you about this stock and it was parabolic. And you said you would wait for a pullback. And this is kind of the problem. This is on me. And I know that some people are going to hear this and it's probably going to sound negative, but I need to actually reply less to new members. And the reason for that, if you haven't watched the masterclass and you haven't really grasped what we're trying to accomplish in Fired Up Wealth, and you come from the outside world and you're used to like Reddit and YouTube and X, you have a completely different mindset and it's almost impossible. It's like oil and water. And it takes a long time to try to get you from the dark side of the light. And a lot of times we fail and they come in for a couple months and say, this isn't for me. I'm going to take my ball and go home, go back to Reddit and lose money, whatever you want to do. But the ones that truly put the time in and watch the masterclass videos and try to grasp what we're doing, that's going to click. And for the ones that do, those are the ones you see some of these, discussions about how much money they've made over the years. It's because they truly grasp what we're trying to accomplish here and bought into the methodology and applied the methodology because it works. this newer member is saying like, oh, I wish I woulda, coulda, shoulda bought it because it keeps going higher. Just because a stock is parabolic, it doesn't mean it can't go higher. Doesn't mean I'm going to go buy it. And that can be really hard for somebody that doesn't understand what we're trying to do here as long-term investors. Because ultimately, most people, like if you're on YouTube, the idea is, well, what stock should I buy today that's going to be worth more in a week? And I sell it and then go to the next one. That's not what we're trying to do here. We're trying to grow long-term wealth. And these stories take years to play out. And I'm not going to chase a stock just because it's parabolic and everybody else is, even if it can go higher. Number one, it doesn't fit my blueprint. Number two, I don't buy a parabolic chart. It doesn't matter if it's going higher. I can't buy it. And so then when it keeps going higher, you have this regret of woulda, coulda, shoulda. It's the wrong mindset. And then you say, hey, have you watched the masterclass videos? No, I need to though. Yeah, you do need to, because your entire mindset is wrong. And that kind of stuff agitates me in Discord. And, people will say, well, you got to be patient. We're learning. I am patient. I'm really patient. You don't understand how many comments I reply to in a day. I'm probably the most patient person on earth if you really understood what I have to do in a day. It's incredible. And the amount of comments and some of the comments I get online. And so I only bring this up so I'm hoping that you can have some empathy and try to look at it from my side, because I do my best to understand it from your side. Like if you're, hey, I only have $1,000, my rent's due, and I'm trying to make a quick buck. That's fine, but that's not what our focus is here. And I can relate to what you're doing because I've been there, and I can relate, and I have emotional intelligence. I have empathy. I'm asking for you guys, anybody watching, that you do the same. And what I do is a lot harder than it might look on the surface, and I'm just trying to help. Just give me some slack too, because I'm just trying to help. Meta platforms. So we're on the second stock in 40 minutes. I got to move a little faster. I'm personally a buyer under $600 DCA. It doesn't mean it's going to get there. The technical setup is neutral, leaning slightly bullish. You can see it has come down a little bit this morning. Everything's selling off. It probably all goes lower. Risk reward though is not really where I want it. It's more of a 50-50 ball. It's not really where I like to buy. When it gets below $600, I think that's where the opportunity starts. Is it going to happen? Probably not. But the previous S3 was 542. Market kind of turned bullish from there. And it did get recently here below like 600 and lower. That's kind of where we're buying it in Discord. The upside here, you can go see 830 on the upside R3. The downside, I'm using the previous S3 of 542. And more than likely it holds up the main S3, but the way the market's going, it's better just to look at lower numbers. Next one is Marvell. Marvell Technology. It's getting to the trend line. You generally want to start buying trend lines, below trend lines, S3s, things like that. So it's kind of in that sweet spot. I drew this up last night when I was prepping. This is your first area DCA, which kind of got in yesterday. And then second possibility is down here. So 62 to 67 is possible on downside. Of course, you still have a lot of earnings left. This is February 26th. This earnings report could be good and it could rip back to $100, or it could drop in this level or even lower, right? It got to $46.93 back in April 2025. So you see what can happen. This happened in a few days, right? A lot of these software names look kind of like that now. And what happened? Well, this ended up being a buy, especially if you're the one trying to flip a quick dollar, right? If you're the one trying to double your money, here you go. Be really careful of that mindset though, because in the end, the house is probably going to win. But this is one you could have bought at 46 and maybe you didn't time it perfectly. You bought it at 55 and you didn't time it on the way up perfectly either. And you sold at 95. Well, you still made $40 a share. So really it comes down to like, is it in your blueprint? If it is, it's probably an area to start nibbling, but earnings can make the stock pop or drop. IBM, for years, this was dead money and income stock. And you say, what do you mean? Well, it didn't do anything for a long time. And I remember I recommended this stock like when I first started the YouTube channel in 2019, and it didn't do very well. It kind of sat there for a long time. If you look at this, so imagine, see if I can find this. 2019. Yeah. So look at this here. So basically here. So for 4 years, this kind of just traded sideways and then it just took off. Now, there are reasons for that. Of course, AI, there's quantum possibilities, there's this, there's that. This is still, though, a dividend stock. It's not an income stock anymore. It used to pay 5%. Now it's paying about 2.28%. Of course, when the stock goes higher, the dividend goes lower. It's the annual dividend, 2.28%. But if you buy this, it's still a dividend stock. You don't buy it as, hyper growth type of a stock or even really a growth stock. With that said, I want to look at some numbers. So it's down 3.5%. Profitability, 58%. This is very much a hybrid. They do all kinds of stuff. But, this only has 5% growth. That's forward revenue growth. That's not a lot of growth. It's not super expensive, but it generally hasn't carried a high premium. And this is probably, if you look at historic PE ratio, this is probably on the high side. And then dividends, it has a high payout ratio. And that's why, it used to be an income stock because it paid a 5% dividend and had like a 57% payout ratio. Anything over like 50% starts to kind of dance with that income stock territory. 26 years of dividend growth, and it hasn't really had the 5-year growth. And so, this is still kind of a tweener DGI income. It's not really an income because it doesn't pay high enough for income. So it just kind of doesn't fit. And it probably fits best in DGI, even though this number doesn't really work. And this number is too high. And so ultimately what that means is most people watching this probably shouldn't buy IBM because it probably doesn't fit your blueprint, especially if you're buying it as a growth stock. I own in the dividend portfolio and I would not consider it in either of the growth portfolios. Even if they do some of the stuff we think they're going to do in quantum, it's going to be still a small percentage of revenue. And that's, you got to understand, it's a big company. Palantir, this is a buy and fired up wealth, $9 to $10. I know I remind you of that stuff all the time, but not everybody has been watching. You might be new to the channel and didn't know that. And you say, well, why don't you recommend Palantir? It's the best company ever. I should buy it at 150. Well, most of us bought it at 9 and 10, some even in like the 7s. And most of us have trimmed it pretty heavily and done cash cover calls and things, and definitely wasn't perfect there. I started selling it way too early, but I made a lot of money on Palantir. And it's still 2.5% of the portfolio, and it's all profit. And I've got more covered calls. I got some nice premiums on like $350 strike prices that are like a year out. So, this is the one that the market says, hey, this is the only software stock that's going to exist. Yet it's still at a pullback, but it held up way better than most of those other software stocks because it would have been like this. And it's crazy because it's the most expensive one. But, it has that cult following. You also get people on CNBC that believe that this is the only company that's ever going to survive in software, and that narrative spreads, right? So is it a buy? Well, it could certainly go to 200. I think it's probably going to go to 200, maybe 250, maybe 300, but it's crazy expensive. Now the results have been good. They crushed it on earnings. So I'm not discrediting that, but you're still paying a huge premium at $150. You got to decide how much you want it, what your blueprint says, and where you would buy it. For some people, they wouldn't touch it with a 10-foot pole. For others with a high risk tolerance, if you can truly accept the downside with the upside, well, maybe it's a buy at 150. I'd be careful. This is an ETF, It's a global robotics and automation. The reason I say that is, number one, these thematic ETFs, they really outperform the market, especially if you hold them for 5 or 10 years. Let me just look at this because I'm curious. How long has this ETF been around? And this is kind of my point, right? A lot of people you might not even look at, like, they just say, hey, I want to get into robotics. This looks like an ETF that's good. I'm not even going to look at the 5-year performance. And ultimately, you don't buy just off the 5-year performance. Past performance doesn't guarantee future results. But if you bought this in 2017 and you held it for nearly a decade, you're up 82%. And if I look at something like the VU, I made that in 5 years versus, 8 years. But in the last 5 years, this is actually down 0.53%. And this is what happens is that you have good stocks, you have bad stocks, the good stocks rip, the bad stocks fall, and the basket just sits there and does nothing. So you're better off handpicking the best stocks within robotics by far than buying an ETF like this, especially the fact that it's actually elevated It was just $42 and now you want to pay 73 and you're buying a bunch of shitty stocks in that price. So, I mean, here's your downside. We talk about risk reward. You don't buy a stock just off of this little fancy graphic. But this is probably your downside down here just by eyeing the chart. And this is your upside R3, Fibonacci R3, 7743. That just isn't favorable risk reward. So all those things together, I would probably use caution and rethink the approach. Samsara, I've been telling you guys, don't touch this over $30. I said, hey, we'd love it below $30 for the community portfolio. I'm still not buying it. I don't have super high conviction. I still need to do some work to really build my conviction on how is this impacted by AI. And I don't really fully have the answer yet. And so I'm not buying it until I have that completely figured out. But, for nearly 2 years, I've been telling you since February 2024, don't touch this stock over 30. It got to 61. If you listened, that helped you save some money. Now, some of you probably started buying it at 30, and that's fine. I mean, all software is going to fall. The S3 is 21. At some point, you would think it's going to find some buyers. Maybe it's $20. I don't know. But the point is, understand what something's worth and don't overpay for it, and that it saves you a lot of hassle. Next one is CIEN. Sienna. Here's the problem. It's going to go higher. And I talked about this earlier. Oh, you said to wait for a pullback and then it went up another 20%. And I could have and this is where people get it wrong because they assume that they would have been able to do that and then sell it. And it's like, it's easy in hindsight to say, oh yeah, coulda, shoulda, woulda. That would have been easy. But to actually do it is a completely different thing. That's why we say no, coulda, shoulda, woulda. But yeah, is the answer? Yeah, the answer is always higher until it doesn't. And some of these charts are great examples of this. Let's just pretend we're looking at chart day here. And this is ServiceNow. And nothing's happened after this. So we're looking at chart day and it's January of 2025, about a year ago. The stock's like $239 a share. And you say, Eric, don't look at a chart. I really like ServiceNow. The thing's on fire, man. I looked at it at 160 and I was going to buy it. And now it's like 240 and I've got a lot of FOMO. I'm going to say, hey, man, the answer is the stock's probably going to go higher till it doesn't. It's going to have to consolidate at some time. I'd wait for a pullback. And let's just say we looked at the chart at 189. So we look at it 189 and say, man, it's probably going to go higher, but it's pretty elevated. The thing went from $67 to 180. That's a huge rip. I don't know if I would want to chase it here. Well, then it goes to 231. You say, well, that Eric guy's an idiot. He told me not to buy it at 190. Now it's 230. Well, Eric's a long-term investor. If you're a momentum trader, if you're a swing trader, if you're a day trader, well, you might have a different answer. But my answer is I build blueprints and buy stocks for 3, 4, 5+ years. And I'm not going to chase it at 189, but I might put it on my watch list and say, hey, if this comes down, maybe I'll start looking at it. And then I also have to do my homework and say, what is it really worth? Well, I think the stock's worth about $140. And that's actually what I told you on YouTube not that long ago. So when it got to $140, I decided I wanted to buy some. And so I bought some at 140. Now that was before software all of it became just throw it all away and it's just going to keep falling and falling and falling. This S3 is $87. It could literally go to $87. Well, wait a minute. You thought I was buying 140? Yeah, because I think it's worth $140. So you're not. You could have chased it here. You paid 189. More than likely, if it gets to 230, 239, you're probably not going to sell it because you're gonna be like, well, I'm only up 30% and I'm a long-term investor, so I'm just going to hold it for the long term and it's going to keep going higher. But instead of going higher, it actually falls. And now you have a $190 cost basis, which is $50 higher. Well, and actually it's a lot more than $50 because you started buying at 140 and your dollar cost averaging. So that cost basis might be something like $120. And yeah, it's going to be down. Maybe it's down 15% or something. But you have a cost basis at 120, whereas here you have a cost basis of 190. I would much rather be in the situation where I have a $120 cost basis and I'm buying more as it comes down than to buy it on the way up and be completely stuck holding the bag. That's the mindset. And so you have to decide, are you the guy that wants to buy it at 190 and trim it at 230 and you're actually going to do that? Are you the guy that understands what something's worth when it starts to pull back, you buy it at certain levels? And yeah, it's gone lower than I thought it would go. That's okay. That's still the approach. And that approach has been very successful and will continue to be. It's not going to be perfect. You can only strive for perfection, but like Vince Lombardi says, you're never going to achieve it. But by striving for perfection, you'll achieve excellence. And we've done that. And year after year, we've proved that to you guys. So it's the same kind of thing, right? You look at this and say, Eric told me not to buy it at $282, and now it's $320. I could have made $40 a share. But at some point, it's going to go up, and it's going to have to consolidate. And usually it has a 50% retracement or correction. And so when it has that 50% retracement, now it's actually going to be down at $200 and you paid $280. And I'm not saying it has to happen every time, but generally speaking, you don't want to chase a parabolic chart like that. Even if the fundamentals support it, it often does not end well. And it's easy when you look at this chart and think of FOMO, but I just showed you what happens. And it doesn't have to be ServiceNow. We could look at, there's a ton of different options you could look at. I showed you this one earlier. Same kind of deal. Maybe you bought it at $210 or $220. And I say, hey, don't buy $220. I think it's expensive. I think it's like $150 stock. You buy it at $220, goes to $270. You could have trimmed and made money, but you're not, because you're like, well, I'm a long-term investor. I'm going to hold it forever, And people, you see that all the time. Micron gets to 500, you paid 67. You're like, yeah, I don't really want to trim it because it might go to 600. Okay, but I'm still going to trim a few shares. And I'm still going to hold it. I'm not going to like liquidate it, but if I have 1,000 shares, I might sell 100 shares. So you buy it here, or say you don't buy it here, and you're watching chart day, and I say, I don't really like it at 220. It goes to 270. You say, that Eric's an idiot. I could have made $50 a share if I wouldn't have listened to him. But the reality is, you wouldn't have sold it here. You would have held it, and you'd be down this much. Now, this is FOMO. So your brain thinks about FOMO, fear of missing out. Oh, I really like this company. It keeps going higher. I've got so much FOMO. I want to buy it. Then when it does this, now you're not excited about it anymore. You're thinking, well, what if it goes out of business? Fear of losing everything. What if it goes lower? What if it goes out of business? 123, I want to buy it lower. I'll wait till it gets to 99. And maybe it does get to 99. And maybe you get lucky and you sniper time the bottom. But if I really like the company, I might start buying it here. And that's a $23 range, which is a big range, right? So if you buy that range and it bottoms at 99, well, now you're 10% down when it gets to 99. Okay. Next is LNG. So recent bottom was 188.20 and it kind of ripped from there. It's 208. You have to be, it's tough because more than likely if the market stays bullish, this could kind of climb up here, but you're also, at any time this could pull back and do a 50% to here. So it comes down to, what do you think the stock's worth? And this is the problem. So many people want to look at a chart and just say, oh, well, if I buy it here and I can sell it here, that's what I want Eric to tell me. I want Eric tell me to buy it at 208 and then it's going to pop to 228 and I'm going to make $20 a share. That's what I want you to tell me. It's not what we're doing. And so you're going to buy ranges and it's not going to be perfect. And you have to decide, well, first of all, what is it worth? Because I haven't done the fundamentals. You say, I don't know. That's what the chart day is for. No, it's not. Chart day is the last 1%. You should already know what you think it's worth by doing your fundamental analysis. So if you think the stock is worth 225, you might be okay paying 208 and be happy if it goes back to 190. But if you don't have that information, it's like throwing darts at a dartboard. You don't really know. So the technicals are kind of neutral, leaning maybe slightly bullish. And you got a range of 183 to 228 on the fibs. Next is FICO. And what I would say, Martin, does it fit your blueprint? I don't think that this company would fit most portfolios because of its profile. you look at the data on it, it's below the S3. I mean, can it go lower? It could double bottom here at 1300. Maybe it double bottoms and pops, but the way the market's at, and how bearish it is in certain sectors like this, I mean, probably goes lower. How low? Hard to know. It could find some support here. It broke the S3, but a lot of it comes back to how much you think it's worth and what your blueprint tells you too. All right. 4 shares, Palo Alto, 159.97 community portfolio. Also, next, this is Trade Desk. And there's really nothing new on this. I mean, I've told you it's a zero sentiment stock. It's going to keep going lower. These could recover and give you 200, 300% return, but there's no catalyst to do so. You're going to have earnings coming up here on the 25th of February, which isn't far away. If earnings are good, it could pop, but earnings could make it go lower. It could drag it below $20 a share. When sentiment gets this bad, it's really important to understand when sentiment is good on something, the sky's the limit. A stock can keep going higher forever. Palantir, Rocket Lab, Tesla, the sky is the limit. They can keep going higher. When that sentiment turns the other direction, hell is the limit. Literally the bottom, right? It could go to nothing. So like this went from 140 to 26 and the narrative has changed, but sentiment is zero. So nothing's changed since then. S3 is 2302. And here's the thing, people are like, what? You bought this stock. Why don't you talk about it? I don't talk about, here's why. So we bought it as spec. When it gets to 1% in the community portfolio, now it's a filled position. So say you fill the position and it's at $35. You can't keep throwing money if the stock keeps going lower. Sometimes that happens. You have to chalk it up as, well, I didn't do a good job in DCA. I didn't think it was going to go that low. But the last thing you want to do is say, well, I'm down 40% on a stock or 30% on a stock. I'm going to keep throwing money at it now to fix the cost basis. Oh, it's a good buy. So I'm going to, it was $50 and you're like, oh man, now it's 40 and I'm down, 15%. I'm going to throw some more money at 40. And then it goes to 30. You're like, oh man, I'm down pretty big on this. I'm going to throw some more money at it and try to fix the cost basis. And then it goes down some more and you throw some more money at it. You can't. So once you get to 1% of the cost basis, so if you're trying to get $10,000 and it goes to $5,000, you still have to use the $10,000 you invested if it's down. And you can't say, oh, well, I've only got 5,000 in it. Now it's only 0.5%. No, it's 1% based on cost basis. We're at 1% and it's down and we can't add anymore. And that's protected us from burning more cash and throwing money at it. And if you end up being wrong and it doesn't work out, no big deal. It's in a taxable brokerage, you tax loss harvest it. That's the whole point of why you're doing it in a taxable brokerage. If you're buying stuff like this in an IRA, this is exactly why you don't want to do it. Because if you're wrong, it's like burning, setting cash on fire and flushing it down the toilet. You get no benefit from it because you can't tax harvest it. If you're in a taxable brokerage, you can take some risk because you can harvest this stuff. You have tons of gains. You can offset some of it. And if Peter Lynch is happy being right 60% of the time, and he's buying value stocks, do you think that you're going to be right every time when you're buying speculative high flyer names? No, you're going to be wrong on names like this over half the time. And so if your batting average is 90%, you're actually killing it, right? You're crushing it. If you're only wrong 10% of the time, your expectation, if you're buying and this is what happens. People will come onto like YouTube and they'll say, I talked to a friend the other day. I love him dearly, but he said, hey, I got about $1,800 and I watched your recent video. Which is the best stock on there to buy that can go up quickly? I can make a lot of money. I'm thinking maybe that Poet one is probably where I should just throw all $1,800 in. Like, have you done any research on it? Well, no, you mentioned it. Like, I'm not buying that stock. I mean, a few members in the community are buying it as like ultra spec, and it's fine if they want to buy it, but they're at least doing some homework on it. And it's one of those things. And again, I'm not picking on you, bud, but it's hard because it's like, I'm trying to teach people, hey, you need to actually invest, build a blueprint, build a portfolio. You're going to have some ETFs, you're going to have this and that. So what happens is if I talk about 100 stocks, but 5 of them are hyper spec, penny stocks that have the most high flyer upside. They have the most risk reward. So they could go up 300% or they could literally go to zero. That's a spec stock. We always say 10x or zero. But your funds are limited. And so, well, I wish I could invest like you, but I don't have millions. Well, I didn't start with millions. I started with a small amount and I still followed the same overall plan. It's improved and tweaked over the years. But what happens is you get 100 stocks, 5 of them are ultra spec. Someone that's kind of casual, playing with the market, trying to make a buck, get rich quick kind of a thing. Those casual people, they see those 5 stocks and that's what sticks out to them because they see the dollar signs. It's like the cats with the laser pens, flashy, shiny objects. And so they go out and buy 1 or 2 of those 5. Well, those have a 50% fail rate because if Peter Lynch is going to be wrong 40% of the time on value stocks, you're certainly going to be wrong, expect to be wrong half the time when it's high spec. And in 2025, you could buy anything and it went higher and you felt like a genius. Well, the market's not always going to be that way. So if you're new, it can really be confusing because you're like, why isn't it like that anymore? Well, the market's more selective. I told you it'd be. I told you that in December. And so they go buy 1 or 2 of these spec stocks and they lose something like this. They go buy one, and this isn't a penny stock by any means, but it's a SaaS type company that would be avoid it or put it in specs 1%. And we even did this as a true spec stock in the community portfolio as 1% allocation. But they go buy like just this stock because, oh my God, it's beat down. It's $40. It was just 140. This thing's going to rocket right back to 140. I'm going to make $100 a share and I'm going to be rich. Well, instead it cuts in half and goes to 20. You can't just buy 1 or 2 stocks. That's like, you're basically playing like Keno or roulette and just like, oh, I might hit on one of these. It's like a lotto ticket. And that's not what this is. You need to build a blueprint and invest and consistently invest in different companies and have diversification. People ask me all the time, how many stocks did you have? The answer is as many as you can manage. But modern portfolio theory shows you can have a lot of stocks. Peter Lynch, the Magellan Fund, oftentimes had over 1,000 stocks and outperformed the S&P 500 by 100% for a decade. He's a legend. And of course, he had a team of people to be able to manage 1,000 stocks. But the point is, you don't have to have 5 stocks to outperform. In fact, if you really understand modern portfolio theory, by having 5 stocks, you're actually taking on a bunch of risks without really gaining much reward in the end. And so it's so hard to convince people of this on the internet because they have these things that they see, it's embedded in their head. They see stuff on TV and once they believe something, you're never going to convince them they're wrong. But I'm a big believer that if you can have 30, 40 stocks and you have time to manage those, that's a pretty good number. Most of my career, I've had 50 to 100 stocks. And people say, well, you can't perform that way. Go look at the data. You can go on Patreon right now and look at the performance of the portfolio. Tell me it doesn't work, because it does. You're still crushing the market. And you're having way more stocks than most people would suggest because you have to be concentrated. All these the community portfolio outperformed every hedge fund except for 1 or 2 that's listed publicly in performance last year. And they have derivatives. They're doing all kinds of trading in and out. And like, it's not tax efficient at all, which I would go broke if I even did that. And we're literally buying and holding and outperforming these people that have quants and they're in their suits and they're trying to be smart with derivatives and buy this and short this and leverage this. You can make money as a long-term investor. And not every year is going to be 2025. We know that too. But if you have a 200% performance over 3 years and you're down 10%, it's okay. You're still made a lot of money. It's going to be really hard for you to lose all of that money, even if you get a catastrophic bear market. Why? Because we trim stocks. We take profits. Trade desks. That's it. And if you do buy something like that, take responsibility. People say, I bought it because I saw this YouTube video, or I saw it because other people were buying it. Hey, you click that button, it's you. It's your responsibility. And there should be no coulda, shoulda, woulda about anything. You're the person making the decision. I'm giving you information, trying to help. And at the end of the day, you got to decide what's best for your money and then own it. This is SoFi. We bought this one $5. Down here, when it was one price to book, we said, hey, this is something you want to buy. Ripped up to 32. We've trimmed it several times. I think 20, 25, and 30 has been a lot of trim areas in the Discord community. S2 is $20.33. S3 is $17.44. You can see the market is down a little bit. Well, the S&P is basically flat. If you're heavy in tech, especially software, it's down. AMD is down, pretty big. I thought the quarter was decent. Software route continues. That's fine. I've got limit orders in. Keep selling it. I'll keep buying it. It's fine. I'm not worried about the stocks that I'm owning and buying. And could I be wrong? Yeah. And that's part of the equation. You're going to be wrong sometimes, and that's okay. People think, I see this all the time with like new investors. Oh, I bought that stock and it was wrong. Oh, there's another free one day. I bought this stock and it was wrong. And I shouldn't have done that. And I lost 20% and I panic sold it. I did this wrong. I did that wrong. Here's the thing. You have to like retrain your brain. You didn't do anything wrong. This is the best analogy I can give you. I said it last night to my broker buddy at the bar. Okay, so let's just say I'm a quarterback in the NFL. My goal is to throw touchdown passes. Obviously, I can hand off the ball. My goal is to score touchdowns. And it's fun for me if I'm a quarterback, if I can throw a touchdown pass to a receiver or running back on a screen. It doesn't really matter. I want to get in the end zone. I want to win, right? So let's say that I set the standard of every pass that I make has to be a 50-yard touchdown pass. And if it's not a 50-yard touchdown pass, I'm a failure. Do you think that's going to be good for your mental state? Because that's literally the same thing you're doing if you say, every stock I'm going to buy, I'm going to make 50% returns and never lose. Guess what? You're going to throw incomplete passes. Guess what? You're going to throw the ball to the wrong color jersey. You're going to throw interceptions. That's part of the process. Even the greatest players in the world make mistakes, but they don't dwell on it as a mistake. They dwell on it like, hey, I learned from it. That coverage is this way. I'm not going to do it again. I'm moving forward. I get the ball again. I'm not sitting there thinking about, oh, last time I threw a pick, you're thinking about, I want to score a damn touchdown. I want to get the ball into my receiver's hands, advance the chains. It doesn't have to be a 50-yard touchdown. If I get a 7-yard reception, that's still a win. Small wins add up to big wins. If your expectation is every time you get on the field, you're throwing a Hail Mary pass for a touchdown, of course you're not going to be happy. You got wrong expectations. When I see people talk about, oh, I made this mistake, I bought this stock and it went down, it's part of the process to be great. You're not a single person on planet Earth is right every time. Not Warren Buffett, not Peter Lynch. It doesn't matter. Charlie Munger, you can name them all. We all are going to make mistakes. You can't be perfect. If you can train your brain to understand these things, it's make it a lot easier. Don't be so hard on yourself. Everybody's going to make a mistake. You're going to have a stock down. So what? And the thing is the story's not even over. If you're down 20% on a stock and you're, hey, why'd you buy it? Well, it's a long-term investment. I want to hold it for 3 years. I'm down 20%. Okay. The story's not over. In 3 years, you could say it was a mistake, but even then it's okay. It's part of the process. You're not going to be right every time, but that story hasn't played out yet. You're using like 2 weeks as the whole story, and that's not it. You bought it as a long-term investment. Retrain your brain, rewire your brain. It's going to help you a lot. This is American Express. The fib range on this is 319 to 402. It's kind of in the middle. And this is going to come back again. Like, why do you want to own it? Is it part of your blueprint? Very few people, that's going to be like, hey, that fits great in my blueprint, especially if you're in the accumulation phase. But it is good to have some diversification, and it's okay to own something like that. Same with JP Morgan. We own some Bank of America. JP Morgan is probably the best bank. It's going to carry a bit of a premium on the PE ratio versus the other banks. I'd say the second best bank is Bank of America. I know like a few people are recommending Wells Fargo I've seen lately. It's okay to have some diversification, but don't just buy it for the sake of diversifying either and not understand what you're buying. SAP, it's selling off with software. And we talked about this one has a little bit higher disruption possibilities than some of these others. Doesn't mean it's a bad buy, but I would expect the stock to go lower. Where? Well, S2 is 148, S3 is 126. Doesn't mean it has to get there, but those are possibilities. These are just possibilities. They don't have to happen. They can always go lower. It's just a possibility, and that's all it is. And this is 1% of your analysis. Don't come on here thinking that you're going to buy or sell just because you saw a red line on a chart. It's foolish, and not in the good way. FOMO chasers got hurt bad on this, though. It was $280 if you chase the top on this. We talk about air pockets. We talk about, yeah, you could buy it at 222 and it went to 280, but you loved it at 222, you're going to love it at 160. That's why you don't overpay for stocks, and you're disciplined no matter what the market does. Don't let the chart or the market FOMO you in to buying, and don't let it fool you out of not buying. Fear of losing everything. Okay. Next is S. I've always preferred CrowdStrike over SentinelOne. Usually if you buy between $12 and $14, it yo-yos back. You can see it gets down here, yo-yos up, eventually came down to the same area. I mean, these sell-offs are epic, guys. You're talking about erasing the entire bull run. This is 2023, and it's kind of crazy because this was actually higher in 2022. This is one in 2022. Cybersecurity is bulletproof. You got to own cybersecurity. And, this was the high here in 2021. It was a new listing, new IPO, and it kind of sold off. But there was times where this would hold up better than it probably should at 28. And I'm like, I prefer CrowdStrike, and I'm not sure I want to pay these prices. You can go back on YouTube. There's videos you can go watch, CrowdStrike versus SentinelOne. There's boxing gloves. So I don't really love this company necessarily, but it could certainly bounce from these 12 to 14 levels, and you could make money on it. We do own a very small position in the community portfolio, and I think it's down something like 10%. I'm not really adding to it. It's just kind of there. It's not like best of breed, and it's not something that, this is something that got voted in, basically. We used to do a vote on what to buy and sell. We don't do that anymore. Okay. So, got to do what's best for you. Don't just buy it because you're trading, because I said that it could bounce from 12 to 14. Buy it for a better reason. And this last one is JBL. And I'll finish it up with some quick real talk, so stay tuned here. This is elevated. If I have not said it yet today, fundamentals are 99%. The last 1% is technicals, and that's what this is. And then of the technicals, this is one tool in the tool belt here out of a bunch of other oscillators and tools we're using. So it's all just tools in the tool belt. This has come down since I looked at it last night. Risk reward's a 50-50 ball. I prefer to buy a stock when the risk reward's here. Now, the problem with this, of course, if it keeps selling, it can, this bar can keep going lower. And so you're just making an educated guess like, well, here's the S3 Fibonacci. Let me just say, well, I'll go back to here and say, there's a decent chance it holds up 170. So this is my downside, and this is my upside. Now you look at that and it's like, well, this is bigger than this. It's not the only reason to buy, but this would be like, oh, maybe I wait for a little bit of pullback. Now, don't be the guy or gal that I say, hey, I'd wait for a pullback, and then it goes to 279 and say, I wish I wouldn't listen, because it certainly could consolidate and go to 279. In fact, it probably leans that direction. It probably leans 51% bullish. But it doesn't necessarily mean it's a buy just because it's going to go higher. And I've tried to show you several examples on charts of why that is. At the end of the day, guys, you always have to do what's best for you and for your money. You can't borrow my conviction. You can't borrow someone else's conviction. I know that you're busy. Everybody's busy. Everybody has jobs. Everybody's working. A lot of you have families. It's very hard to find time to make time to put time into investing in your future. The reality is, though, is that this is one of the most important things that you can do. And there's a lot of other things that you prioritize that you probably shouldn't prioritize over this. So if you really want to take your game to the next level, and you're, in the private community, which is closed now, but watch those masterclass videos. There's so many people that say, yeah, I'm going to get to it. You should be doing it. And I mean, honestly, it should be a prerequisite before you're even able to talk and, to reply and comment in Discord to at least watch half of those videos. And there's no way to really manage that, but that's kind of the expectation. My expectations are very high for our community. If you're on YouTube here and watching this, I appreciate your support. Sometimes the stuff I say might be a little bit difficult to fully understand because you don't understand the methodology and what we're trying to do unless you've been following this channel for a long time. But we are long-term investors. We're generally investing for 2, 3, 4, 5 years on stocks. We're holding them, buy, hold, and monitor. We're building out these blueprints that are diversified with ETFs, with dividend stocks, with growth stocks, with some spec stocks, trying to balance. It's about risk management, buying different sectors within that risk management, and trying to focus on secular trends if I'm in the accumulation phase so I can get to that millionaire status. Trying to recreate what I did when I was younger to get where I am now. The 3 public portfolios are roughly $4 million right now. There's the community portfolio, which is 8 out of 10 risk. There's the main portfolio that I'm starting to de-risk, been taking profits from that, from those growth stocks like SAS, and rotating that into the dividend portfolio, which is preservation. So 6 out of 10 risk on the main, 3 out of 10 risk on the dividend portfolio. That dividend portfolio is for passive income. We've already built that to $830,000 in a year. Most of that's from profits. And I'm going to continue to trim profits when there's opportunity, in certain stocks. And I'll take like ACMR, just sold out of that one, take the profits, either put it into something else within the main portfolio that's a little bit more in the profile for that risk profile, or, convert some more cash into the dividend portfolio and keep growing that. Understand where you are in that journey. If you're young and or you have a long time horizon, 10, 20 years, you're probably in the accumulation phase. You probably have something like maybe a 7, 8, 9 risk tolerance. Most people don't have a true 10. But if you call yourself a 9 and you're down 4 or 5% yesterday and you're freaking out, you're not a 9. You're probably like a 6 or a 7. Understand your own risk profile and adjust that portfolio to that risk profile. But I appreciate you guys very much. Hopefully this is helpful, educational. I'm confident that if you buy the right stocks, you buy against the grain, you're buying some of these software companies that are mission critical to enterprise, that they will recover with time, but it's going to take time. They're going to have to prove themselves to Mr. Market. That's going to take several quarters of proving it. And you've seen some of these stocks, like look at PayPal as an example. Obviously not SAS. But over the past 5 years, this is down 85%. And when sentiment gets bad, this is what happens. So is it possible that some of these software stocks can flatline for years because the sentiment's zero? Like a trade desk we looked at? Yeah, absolutely. That's why you have to have not just 5 stocks. You got to have a basket of stocks, and you have to know how to manage risk, because these are going to happen and you're going to be wrong sometimes. A lot of people would have said, hey, PayPal is a great buy in 2022 at $77. I wasn't one of those people, and I haven't owned it. But you might have thought it was a great buy at 71. And then at this point, it was 90. And you're like, finally, it's paying off. I've been patient. I'm a long-term investor. I held it for 2 years. It's finally paying off, and it's going to go to the moon. I'm buying more. Well, then you zoom the lens out a couple more years, and it lost 50% of its value. And you're down 85% in the past 5. You invested in it in 2015, 10 years ago, you're up 20%. Excuse me. You could have made more money off a money market. That's miserable. And that's going to happen. Even the best investors are going to, there's a lot of reasons that people could have liked PayPal. And you could have said, well, I would have bought it here and sold it here. Well, you could say that in hindsight, could have, should have, would have, but probably not, right? In the end, guys, do what's best for you and your money. The biggest thing is that you understand what you know, or understand what you own, know what you own. So understand what you own, have conviction in what you own, have your risk tolerance built correctly for your blueprint. So in other words, if your risk tolerance is a 6, make sure the stocks you own fit 6. If you need help with that, let me know. I'll try to help. Right? And then make sure you have a plan, that blueprint, the correct time horizon, correct expectations, because you're not throwing 50-yard passes every time you pass the ball. You're going to be wrong sometimes. You can't beat yourself up over it. All of these things together will help you be a better investor, to navigate these storms, take advantage of opportunities to buy against the grain, and more. So if this video was helpful, please do drop me a comment, drop me a like. If you're not subscribed here already, please subscribe. Have a great rest of your day, guys. We'll see you.